Hello, I'm Eric Ogard, Chief Investment Officer of the Wealth Plan Group. I'm here to demystify the complexities of capital market returns and your stock portfolio. So today's a very interesting time economically. We have positive things to think about, but we also have some challenging things to think about. And those forces are colliding in the markets, oftentimes leading to confusion or bewilderment on the part of investors. We really want to distill the things down to what really matters. So what we like to do is we like to take a macroeconomic point of view first before we think about what's happening with stocks and bonds, to contextualize what's happening in the broader economy in order to make sense of what's happening in the capital markets. So that being said, there are a few very positive things at work right now in the economy. The first is that the US economy is growing. GDP has been very resilient, even in spite of expectations for challenges. Those have not come into play, and the economy, quarter after quarter, post-COVID, continues to be resilient. On top of that, corporate earnings are accelerating. So we went through a trough post-COVID. People were concerned about companies' ability to deliver growth. Estimates came down. Then we started getting a recovery in the economy, and companies started posting results that were really quite good. Now we're in a position where analyst expectations, and when we think of analyst expectations, every company, usually of any size, has many analysts from Wall Street creating expectations for forward earnings. When we aggregate all of those earnings together and create a picture for expected stock market gains, we're looking at expected returns in earnings for US corporations on average of about 10%. And on top of this, consumer confidence remains positive, which leads to positive consumer spending. And recall, the consumer is 70% of US GDP. So what the consumer is doing matters. Those are the positive things at work in the economy. Here are the things that are a little bit concerning. One, equity valuations are quite stretched. There are different ways to measure what stocks are trading at, but what we find is stocks are really in the top decile on their valuations, meaning that they're priced for perfection, and boy, those earnings had better come in. They may, but that's a challenge when valuations are so high that you could say things are priced for perfection. And then on top of this, we have a very stubborn inflationary picture. Presently, inflation is at about 3.3%, hovering well above the Fed's target of 2%. So because of that, expectations for a rate cut from the Fed have been put off. And whenever interest rates are up or going higher, that is a challenge to equity valuations. Equities are long duration assets, meaning that their earnings come in over many, many years. And when the interest rate goes up, that's how we discount the value of those future earnings to today. The fact that rates are up and staying up is a challenge, a headwind for stocks. Finally, federal debt burden is really high. The Fed is spending, we've got deficit spending at record levels, and with interest rates higher, the debt burden itself is very high. Those are the things that are causing consternation among investors. And in particular, when you think about the slightly more volatile situation in the Mideast, folks are on edge a little bit, and all of this creates some uncertainty. And with that, I'd like to turn our attention to equity markets as our segment of the week. Stocks get a lot of attention from investors. They're a large part of portfolios, and they're really the part of the portfolio that's responsible for growth. We see ourselves as being in a really important time when it comes to the earnings of companies in the stock market. We're now entering first quarter earnings season reporting, where we'll get a very good read on how companies are progressing along the expectations that analysts have for them. And it's going to be important that we get numbers that support the valuations we've got today. So if there's any bit of angst, it's around what kind of earnings are we going to see. We're going to learn a lot over the next 3 to 4 weeks. There's been some discussion of the Magnificent Seven, or the so-called Mag 7. Perhaps you've heard of it. This is NVIDIA, Microsoft, Apple, Meta, Google. These large cap tech companies have driven market returns over the last year. And the big question is, are we going to remain in an environment where these few stocks drive returns, or are we going to experience a broadening of returns to include smaller cap companies, mid cap companies, valuation, or what so-called value companies? These are the things that we're looking for to indicate capital market health. When we get broader participation, that does a lot for the stability and strength of an equity market. So we're looking to this next few weeks of earnings season very, very carefully. And we're hopeful that these weeks will in fact demonstrate the tailwinds that we've talked about. Strong economy, strong consumer, corporate earnings continuing to grow. So we'll check back in. In the meantime, follow us on LinkedIn, on YouTube, Wealth Plan Group, and I look forward to speaking with you soon. Thank you.